Are you aware of the Shiza-Niyama Index?
Probably an advisor that has a client-centric mindset.
The fact that many of these sectors have incredibly strong
and also create a bit of distance between the investment process.
Talking about CPD, I always refer to it as continuous.
I'm part of the legal counsel from 91 Asset Management.
You've got to be moving towards something, not away from something.
The concept of being an influencer or having influence in your network.
Good morning, everyone, and welcome to another monthly webinar. We've had many interesting events happening over the recent months, and for those who may remember, earlier on this year, we had a big credit event with breach taxi finance affecting some income funds. And though today is not specifically talking about that, we did wonder and we did ask ourselves the question, but how credible is credit as an asset class in South Africa? So for many, credit, bonds, any of these fixed income instruments may seem a bit sometimes boring, or for others a bit confusing and even a bit overwhelming. So even for someone like myself, I much rather prefer to talk about growth assets, and I often find it much easier to understand. So I thought, let me rope in one of the experts, JP Matthews from Matrix Fund Managers. He joins me on the call this morning, and JP he actually is part of the Matrix team. He joined Matrix in 2019 as head of product. He's responsible for the development and the distribution of the Matrix product range. He's also a key individual, a representative, and a member of the investment committee at Matrix. And he started his career way back in 1996 as a fixed income analyst and trader. He has been a long-standing proponent of the hedge fund industry in South Africa and was involved in the establishment of various alternative asset management and securities trading businesses over the years. And before joining Matrix, JP was a portfolio manager and head of business at a large institutional alternative asset manager. He holds a degree in actuarial sciences. He's a CFP member as well as a CFA charter holder. And also, and this is maybe also why it's so nice to have him on the call this morning, is that recently he joined the CISA working group that focuses on the mandatory disclosures on income funds. And also, for those who don't know, Matrix manages our Amity BCI Diversified Income Fund. So a great way for introduction this morning for all the associates on the call and for some of the prospects on the call this morning as well, for you guys to get a bit of a brief introduction into the Matrix team. So quite a mouthful. JP, thank you so much for joining me on the call this morning.
Thank you, Tanya. We're very happy to be here and also very honored to manage a portion of your portfolios.
JP, you and I had some offline discussions about, how are we going to tackle this webinar, because I think there's a lot to say when it comes to credit. And like I mentioned, I didn't want to make it specific to the event that unfolded recently and how some of the income managers or income funds actually were affected. But I thought we should maybe take it a bit of a step back and maybe as a start to share, you can share some thoughts and some research that you've done on, I think, firstly, the growth of the income unit trust funds in South Africa. I think that's firstly a question I'd like to maybe ask you. The appetite, has it grown in South Africa? I mean, you have this slide on now, but maybe take us a bit through exactly that, the landscape of the income unit trust funds.
Yes. So Tanya, I mean, it's actually mind-boggling when you look at some of the stats, CISA stats in the unit trust industry, how the fixed income only, if you want to call it that, funds have grown over the last, 7 or 8 years. And we've got a graph here that just shows you the size of the SA unit trust industry in December 2015, which was around 1.4 trillion. And we had about 250 billion in fixed income focused SA unit trust, being short-term IB, variable term, and multi-asset income. So now, end of last year, look at the CISA stats, you'll see that portion has grown to about 820 billion, and now roughly a third of the SA unit trust industry is fixed income related funds, and that's even excluding money market unit trusts that aren't included in that number. If you add that, roughly half of the industry is now fixed income only. If you like, I can quickly expand a bit on why we think we've seen this growth, and it's not just got to do with the fact that balanced funds and equities, etc., have performed less than the market has expected, but it's also really due to, we feel, a massive paradigm shift that we've seen in South Africa, and we call it the bad news and the good news. So this is a pretty intricate graph, but basically what it shows you is the sovereign credit spreads of different emerging market countries with credit ratings ranging from A-grade credit, which would be this green line country like China, for argument's sake. The blue line here would be a BBB rated sovereign. This is for global debt, country like Mexico. And it's interesting to see that a country like China will pay around about 1% more for their global debt than, say, a AAA country like, say, Switzerland or the UK. Country like Mexico, that's BBB, it's still investment grade rated, would pay about 1.5% more. And then you move into what we'd call non-investment grade or high yield issuers, and those be sovereigns, in the BB space, something like Brazil. And Brazil would pay around about 2% more for their global debt. South Africa at the moment is also rated BB. And we then move deeper into high yield. You get to the single B credit ratings, which would be a country like Turkey. For argument's sake, they'll be paying roughly 4% more for their debt than a AAA rated sovereign. Now, it's very interesting to see that also as markets go through a little bit of pain, so these dark patches here are recessions, that the volatility of this extra spread that you need to pay because of your bad credit rating is also quite volatile and can spike up in times of economic turmoil. Now, when you superimpose South Africa's rating and our spread change over time, you'll see that there's been a massive change in our credit spread as a country, as a government. So in 2015, end of the year, when Nenegate happened, the whole rest of the world started perceiving us as a sub-investment grade credit. Long before we actually had our sovereign credit downgrades, we had been priced by global investors as being sub-investment grade. That happened towards the end of 2015. And what happened was the South African government, where they were funding on this dark blue line, we now had to start funding on this light blue line, adding roughly an extra % to our funding. And it's what is a bit concerning is seeing that we're now dislocated from BB and we are trending towards single B. So the bad news is that our government needs to pay more for its debt. The other bad news is that because the government is paying more, it really spills through to the rest of the economy, and most corporates and financial institutions will have to pay more for term debt, and coupled with that, the Reserve Bank is keeping short-end rates high, also to attract global flows. So the bottom line is that now, 10 years after Nenegate, we are all paying roughly 2% more for our debt, all things being equal, than we used to. That's the bad news. So the good news is that we're all paying more for debt. So if you are an investor and you have got some extra savings, you'll be earning a higher yield now than you used to earn pre this paradigm shift. And we have a graph here, we call it the rhinoceros graph. But what this graph shows you, which I think is very interesting, is just the shift in real yields over time in the different fixed income asset classes. And I'll show you a few of those a bit later on that you could achieve right now. And basically, we take the yield on this dark black line is the repo rate, which is roughly the same as making an overnight call deposit. And what we subtract from that rate. So at the moment you can get about 8.35 or so on an overnight fixed deposit. We subtract from that expected inflation over the next year, and we get to a real yield per asset class. And what this graph is essentially telling us is that on overnight fixed deposits, you can earn inflation plus 3.5% at the moment, which is insanely high relative to the past. So if you look at once again at 2016 pre-Nenegate, if you invested in overnight fixed deposit, the chances were you'd never beat inflation on a money market investment, right? But now, when you say on the green line, move to 1 year fixed deposits, you can get inflation +4. If you invest in inflation-linked bonds, so in the 10-year area, you can get inflation +5 with a very high degree of certainty. And if you buy some of our nominal bonds, 10-year South African government bonds, you could get an implied real yield of over 6%. So these are very, very juicy real yields. So this is over and above inflation. And what we have seen is that fixed income investments have been crowding out other asset classes. And it's something that you see in the rest of Africa, and something that you see in countries where they have lost their sovereign credit rating. So this is really a new world, a new South Africa. And I think where investors are concerned is that why should I chase a high risk return of inflation +8 or 9 in a risky asset class if I can get inflation +4 to 7 out of fixed income, which is perceived to be a much less risky asset class, right? And I think that's really been driving a lot of the flow we've seen in fixed income funds.
And I mean, you know, you talk about this now, and I can then start to obviously understand why it is so attractive for financial advisors to make use of this within their portfolios. But if I maybe take it a step back, and I think you're going to share with us some slides now on this. But firstly, I think debt in itself can have this intuitively bad connotation, right? So people in their personal capacity have often a bad connotation with the word debt, but yet debt is part of the instruments that you purchase, one of the many instruments that you can make use of. And I know some of the slides you have here, you talk about terms like tradable debts, you talk about some of the landscape of credit, but I really want to ask you if you can maybe take us through a bit of this. I think it's terminology that can often overwhelm us. And also if we do not understand necessarily that not all debt is created equally, feels like I'm quoting Animal Farm here, but some debt might be more equal than others. But how then should, you know, obviously advisors consider making use of this if they are chasing these returns of inflation +3 or +4%? It's lucrative, but there are risks, you know, attached to this, and then also having to understand what it is that you are investing in. So quite a long-winded question perhaps, but firstly, maybe take us through that landscape of the credit markets.
Yeah, no, I mean, it's very pertinent what you're saying. And I think that, you know, as we see the increase in the portion of fixed income investments in our industry, I think we're all on a voyage of exploration and also increasing as an industry our knowledge of a fixed income market, which is much more nuanced than you may have thought. And, you know, I can see discussions around the BRI moving towards MPC decisions rather than what Tencent or Naspers is going to be doing in the future. So certainly, I think we as an industry are all brushing up on our knowledge of fixed income, and there's a lot of jargon, and I think that's the important thing. It's not very complicated, but there's a lot of jargon that a lot of the industry needs to get to grips with. A lot of advisors just need to get to understand some of these terminologies. They're not difficult to understand, but there's a lot of jargon, and I'll take you through some of that jargon and give you a helicopter view of what the fixed income market looks like. And I kind of like this. We did something with the Mona Lisa theme a little while ago, and I think in income funds, definitely there's a lot more to income funds than meet the eye, and we need to look to understand things a level deeper to get to understand specifically the relationship between the yield you receive and the credit risk that you take. Okay, so this is a very simplified chart of the type of issuers of debt in our country. So issuers of debt are just institutions that are borrowing money, right, from the investing public. It's important to note that the South African government is the biggest borrower of money from the investment market. And the way that the government typically borrows money would be to issue government bonds government bonds essentially just promise the holder of that bond a semi-annual fixed coupon, which would be the interest that the government pays, and then your money back at the maturity date. Right. So those are tradable loans. So fixed income is all about borrowing and lending money, right? And if you think about it, what is an interest rate? Interest rate is the price of money. So if you don't have money in your bank account and you want to have some money, you can always go and buy some money by paying a certain rate of interest, right? So I will give you some money as long as you pay me interest and my capital back at the end of the term. The amount of interest that you pay will be directly related to the term of your loan and also be related to your credit worthiness. Okay, so that's, and we'll go into a bit more detail of that. Okay, so let's think about what's not credit. So we use this word credit in fixed income investments quite loosely. And I'll give you a bit more of a nuanced description of what we would think of as credit. So firstly, in those previous slides that I showed you about South Africa's global credit rating, its US dollar-based debt rating, we saw that South Africa was rated BB or BB minus, right, which is sub-investment grade. And that's our ability to repay debts in a foreign denominated currency. But when we move onshore now and we look at South African debt in rands, then we must remember that the South African government has the ability to tax its citizens, and it has the ability, if needs be, to actually print money to repay its obligations in rand. So when we consider the South African government's ability to repay rand-denominated debt, we realize that they are the best creditor that you can have. Well, debtor, sorry. They are the best credit-rated debtor that you can have if you were to extend a loan, right? So because SA government in national scale rating is rated AAA. And essentially the market would then consider government guaranteed debt to not attract any credit risk because of the fact that it's AAA rated. There's also a debatable section of our market which revolves around fixed deposits with big banks, so the top 4 or the top 5 banks. So typically when we talk about credit, we would also not include fixed deposits made with some of the larger banks. But in other literature and in other viewpoints, you could potentially view a bank debt also as credit, especially when you look at lesser credit-worthy banks, not necessarily in South Africa, but across the world. There are also banks that are rated poorly and banks that are rated well in terms of their credibility. All right, so what are credit markets? So firstly, we look at the green blob here, and the first big group would be something like banks and other regulated financial institutions like life offices. So that would be all the big 4 and 5 banks, plus maybe 2 or 3 other South African banks. They all offer fixed deposits, and they also issue bonds similar to South African government bonds that you can invest in. And typically, this is quite a large market in South Africa, and it's a market that's pretty well known because we all know the big name brands. So we all know who Absa, Standard Bank, First Rand is. We all know Nedbank. You know, we have a good feel for those companies and those banks, and they're all well researched. And there's a feeling of comfort when you invest in credit that's issued by the banks. There are nuances here because banks also issue what we call subordinated debt, and we'll talk about that a bit later. That's quite a large market. You get also subordinated debt issued by Sanlam Mutual, etc. So that's an area of the credit landscape that I think we all feel quite comfortable about. Then there's another area of credit that we will loosely term SOEs, so state-owned enterprises and municipalities. So we know that there are some issues there, and not all municipalities are born equal. We know that there are a couple of issues regarding the credit worthiness of some of these parastatals and municipalities, and it's important to note that the SA government doesn't explicitly guarantee any of this debt unless it specifically notes in an issuance of some of these SOEs debts. So say some of the Eskom bonds may have an SA government guarantee, and they're obviously priced differently from other bonds that do not have an explicit government guarantee. So the government guarantee is quite tenuous in this space, and it takes a lot of homework to really ascertain the creditworthiness of different municipalities and different parastatal business. Typically at Matrix, we don't get involved in that, but there are a lot of asset managers that make a good living out of doing that analysis work. The next big group of credit issuers would be corporations. So companies also need to borrow money to expand, and those companies can also go and issue debt on the JSE. So some of the large blue chip businesses in South Africa have got listed bonds that you can buy on the JSE. And also some of the banks like to issue what we call credit-linked notes. So credit-linked note is a way for a bank to sell off some of its loans to the market or to lessen some of its credit risk by extending you a deposit or a note where the bank will repay you your debt subject to a corporate not defaulting, and typically that be a corporate that they've had a big loan exposure to. So corporate debt and CLMs would be another block. And then a fourth block would be securitization structures and securitized paper. So I've added a slide or two on that as well, just to give you a bit more color on it. But essentially, securitization structures, and I mean, lately this bridge taxi finance was quite topical. Securitization structures essentially consist about a group of loans. Typically, those could be auto vehicle financing loans, could be credit cards, could be a host of other type of home loans, for argument's sake. So SA Home Loans, they have a Tukwini securitization structure where they issue some securitized debt out of. And what makes securitization structures difficult to understand is that the name of the issuer doesn't always tell you about the nature of the risk underlying the securitization structure. Once again, asset managers that invest in securitization structures, I would hope, spend a considerable amount of time understanding the nature of that pool of underlying debt to ascertain whether there is adequate liquidity and spread on offer. So those are the four main categories. Maybe also just to give you an idea of the size of these categories, and this is really where the squeeze comes in. If you want to run an income fund that's giving your investors the highest possible yield, you need to go after paper that there's not a lot of around in the market. So if we look at tradable debt or investable debt in South Africa, we see that there's roughly about 6 trillion rand of tradable debt out there. The vast majority of this tradable debt is SA government bonds and other instruments that the SA government has issued, so treasury bills and other new floating rate notes, etc. But it's pretty boring because remember, this is the best rated paper you can get, and it typically doesn't pay such a massive return when compared to other less issued but highly yielding papers such as the SOE municipalities securitization debt and corporate debt and CLNs, right? So this year is really the higher yielding corporate, the high yielding credit. And then we've got the section in the middle, which relates to bank debt, of which there is quite a bit of it out there, probably between 1 and 2 trillion rand of bank debt that you can invest in, which will be fixed deposits, senior listed bonds, and then subordinated paper like tier 2 and AT1 paper. Right, so I think that gives us a good feel of what the universe looks like and the availability of that paper.
JP, before you maybe move on to that next slide of yours where you start to talk about the government debt, just out of interest for some of our viewers as well, is there any instruments that Matrix, for instance, won't necessarily consider?
Yeah, so in our business, we have a focus on liquid paper, like so, because we are a pragmatic investor, which means that, you know, we change our minds from time to time about the positioning that we have based on new information flow. If you're a pragmatic investor, you need to stick to liquid portions of the market. I'll show you a nice graph now, which actually I'll zip to that now. If you're a pragmatic investor and you need to sell out of your paper when you change your mind, you need to stick to liquid instruments, right? So for us at the moment, the way that the South African market works is in fixed income, there is a lack of liquidity in the credit market. And the primary reason why we have not been investing in credit or even subordinated bank paper is due to the fact that credit is often seen as a highway in and a gravel road out, right? So it's easy to buy credit paper when the paper comes to market, but it's very difficult to sell credit at a price that you have been marked to market at. So it's tough to get rid of credit when you need to. And it's got sometimes very low levels of liquidity, which presents additional risks to investors. So if you look at our style, and once again, we combine very well with other investors that focus on credit. So we're not saying credit is a bad thing, because in credit, you're going to get, you know, high yields. But you need to ensure that your credit manager, you know, has a firm grip on all of the credit risks that are in that book. Other interesting thing about credit is you can't diversify enough, really. You know, if you think about most other markets, equities, etc., there comes a point where if you hold an extra equity in your diversified portfolio, you're not going to get the diversification benefits.
Yes.
But in credit, it's a bit different. The more you diversify, the better. And once you move away from you know, investment grade or a highly rated paper. So I guess if I want to summarize what I just said, we spoke about the yield that you received earlier. There's this thing called 3-month JIBAR, which is just a 3-month fixed deposit rate. These little numbers in this table here just shows you that you get JIBAR plus a spread. So you get extra return for the longer the term of the loan that you grant through the instrument that you buy. So the longer you invest, the higher yield you're going to receive, and the lower the credit worthiness of your counterparty, also the higher the spread that you're going to receive, okay? Which means that if you were looking to earn JIBAR plus 600 basis points, which is where some of this securitized debt was issued, you, in the 5-year space, you know, your implied credit rating would not even be on this grid. It would probably be somewhere around a single B type of credit rating to obtain a spread of JIBAR plus 6%. So, but what is more important for us when it comes to the way that we manage fixed income funds, we want to stick to the green sections, means that there's liquidity, means that we can sell paper if we need to. Red is little liquidity. So if we look at liquid paper, AAA rated South African bonds and inflation-linked bonds, AA issuers that are liquid up until about 5 years, you're looking at SA big banks in the senior debt, and then you move down to subordinated debt, typical corporate debt that will have less liquidity. So it's important for us to stick to this section.
I'm gonna while we are on this slide, I'm gonna ask the question now, and we can maybe come back to the others. But so many advisors use income funds, then especially if they maybe follow a bucket approach, that first 2 years of the client's income in a type of an income fund. Some of them even go as far as to maybe pay out the client's money market or their income out of a money market and an income fund, or a blend of the two, or even use it for what we've seen in the goals-based space for essential goals. Clients who don't want to lose money and they place it almost like an emergency fund. But it does seem there are certain risks when you consider income funds, risks that maybe isn't as obvious to the typical advisor. I mean, your slide here highlights credit risk, yield, liquidity, but I'm thinking there must be some stuff that you might, and I think one of your slides now showing that pricing of that Credit Suisse that we earlier spoke of, or off screen we spoke of that Credit Suisse event, but what are the risks involved in, and what often do we miss in this space?
Yeah, so I think that's a very good question, and I think maybe I'll answer that or by showing this table here as the type of questions to ask if you don't have a DFM, the questions that investors should ask when investing into income funds, and also levels of comfort. Okay, so the first thing is, if the yield is the average interest rate that you're earning across the portfolio. If that average interest rate that you're earning is too high, if it sounds too good to be true, it usually is, right? So we have this benchmark in South Africa called the Steffi Composite. I'll show you what it looks like a little bit later, but essentially the Steffi Composite benchmark is an average of fixed deposit rates. Okay, so an overnight fixed deposit, you're going to get around, call it 8.3, 8.4%. A 1 year fixed deposit, you're going to get like 9%. So the average money market yield you'll get will be somewhere between 8.5% and 9%. Let's call it 8.75 or whatever the case would be. So let's say if your yield that you are earning on your fund is way in excess of that, it's an indication of the credit worthiness or the term of your paper that you're holding, which will give you an idea of the liquidity of the underlying loans that you've invested in, right? So if your yield is much more than, say, Steffi plus 1.5, which would imply, sort of yields northward of 10.5%. If your yield is northward of 10.5%, you just need to start asking yourself, what is my interest rate risk there? What happens when rates change? What is my credit risk in terms of the credits that I'm exposed to? And what is my liquidity risk? Because I may be picking up this extra bit of yield because I'm investing for a long period of time. I've committed myself to lend money for 5 or 6 or 7 years. Right, so a very high yield is definitely an indication not of how good the fund is, but just of how much potential credit risk or term risk you have taken on board in your investment. Okay, so it's almost sometimes a reverse indicator of the quality of the loans and the quality of the paper that you've invested in. Okay. So the second thing that I think we all feel quite comfortable about is this concept of duration risk. So we all usually on our MDDs, when we're investing in bond funds or income funds, have this number called modified duration. And basically what that just tells you is how sensitive is the fund's NAV to changes in interest rate markets. Because remember, you go through this yield curve that changes all the time, and how sensitive is your book to that? Now, typically, if you're investing in a short-term IB portfolio, you have a max duration of 2 years. What does that mean? It means that if the yield curve moves up by 1%, you're probably going to lose 2% of capital value on your fund. If the yield curve drops by 1%, you're going to make an extra 2% on the day. All right, so that can add a bit of volatility to your portfolio. So if you're in the multi-asset space as well, duration can go up to 2 or 3 years. And you just have to be aware of the fact that the higher the duration, the more exposed you are to interest rates. But it tells you nothing about the credit worthiness of the underlying paper that you bought. All right, which brings me to the next point, which is the average term to maturity. So we haven't spoken about it much today, but the different types of instruments that you can issue, some would be fixed rate bonds, some would be floating rate notes. And what a floating rate note is, and that's the It's the instrument of choice for securitization paper and the instrument of choice for corporate papers to issue floating rate notes. And what typical 5-year floating rate note is, it's made up of short-term 3-month fixed deposit rates. It says, say the average fixed 3-month fixed deposit rate in the market is 8.5. Then I would say, Tanya, if you buy my floating rate note, I will pay you 150 basis points or 1.5 or say 2% more than the average 3-month fixed deposit rate, as long as you keep on rolling it every 3 months for the next 5 years. That extra spread that I'm paying you is dependent really on my credit worthiness and the term of the loan that I've got from you. So for argument's sake, on say some of the securitization paper that was in the market recently, the duration of that paper, because it resets its coupon every 3 months, was less than 0.25 of a year. So if you say my duration on this instrument is 0.25, you'd think there's very little risk, and there is very little interest rate risk. But it didn't tell you anything about the credit risk of that issuer. Okay, and what becomes pertinent then is how long do I still have to keep on rolling this floating rate note with that issuer? And the longer that term, the more I'm exposed to changes in credit worthiness. And typically, securitization paper would be 3 or 5 or 7 years of term that you are committed to provide funding to that underlying issuer. So for us, the term to maturity is important because it gives you an idea of the sensitivity to credit rating movements and to default risk of underlying issuers. And then there's a whole bunch of other questions which I don't think we have to cover it here today, but there's different types of bank paper, there's subordinated, senior. Within subordinated bank paper, there are 2 different types. There's credit linked notes, which we spoke about earlier. There's outright corporate debt, there's securitization debt, etc. And it's really important that you or your DFM have a firm grip on this underlying exposures that are inside that fund. And the highest yielding fund is not always the best credit worthy fund.
And JP, I think this is quite valuable because like you mentioned now, there are definitely advisors that may not want to make use of a DFM for whatever reasons. So this is a very useful way to maybe ensure that these are the questions you ask the fund manager, or if you go to some sort of due diligence, and that you kind of know that a fact sheet alone might not be sufficient. But I jumped the gun now, so apologies for that, because you were busy talking a bit about some of these underlying instruments, and there was a slide, if you go back a couple of slides maybe, where you talk a bit about the SA government bond, and you have that yield curve on there with, and I mean, these are also terms that we often hear, the R186 and R2030 and all of these, and then talk us a bit through about some of, and I mean, these form part of that previous slide of the SA tradable debts pie chart that you obviously gave. And so if I understand correctly, this is the component that's still the largest in terms of that tradable debt share. But it also looks quite attractive. I mean, earlier you mentioned there you have a fairly good, if you have on your real 10-year SA GDP yield is 6.6. So, but how does this spread work? What do we need to look at when we have this slide up?
Okay, so I think the first thing is when you're looking at the government yield curve, the important thing to note is that there are probably only about 10 government bonds that are very liquid, that the government is funding their deficit through. Those bonds would be traded in massive volumes and liquidity every day. And most of the funding that the government likes to do is longer term funding, sort of from 5 years out to 30 years. And the more you can fund on the longer end, the better. But the thing is, when you're looking at income fund investing, you tend to focus on a shorter term year. So the average term to maturity for an income fund is usually less than 5 years. And we have in our country, what we at the moment, we have quite a steep yield curve, which means that you get paid a lot for longer term debt. So maybe you can get 12% for 15 or 10 to 15 year debt, but you're only going to get 8.5 or 9% for shorter dated debt. So typically, when we're investing in the income fund space, you're limited to 2 or 3 government bonds that you can purchase that are on the shorter end of this yield curve. Small bond funds and balanced funds that would venture towards the longer end. The reason also for that is that this yield that you earn on the longer end of the yield curve comes with a commensurate amount of volatility. So the volatility in government bonds that are 10 years or longer tends to be about 7 or 8% per annum, which just means that if your running yield on a bond like that is, say, 11 or 12%, in any one given year, you could get a return of somewhere between 5% and 17%, for argument's sake, because there's a high degree of volatility in that. Whereas if you're looking at income fund investing, you don't want that volatility. You're looking at duration, exposure, or volatility of these instruments of less than 1 or 2%, because if you're investing now at 9%, you want to be sure you're going to be either earning sort of 8% or 11% rather than those wide ranges. So for income fund investing, you're going to be focusing on the side of the yield curve. And there's not a lot of government bonds that are in the short end of the curve. And it kind of forces you also, because you want to be competitive with other fund managers, it forces you into other types of paper. As we mentioned, the first type would just be buying, bank fixed deposits, which are also super boring, and they yield you a fair yield, we think, and an amazing yield at the moment. But if you want to win prizes, you're going to have to push the boat out a bit and start looking at some corporate or securitized paper to up this yield even more. But for us, we think the best yield value for money at the moment in the market is probably 1 year fixed deposits. You can earn northward of 9%, which is in excess of inflation plus 4% of expected return at very little risk. So this is the type of instrument that would find its way into a lot of our portfolios, where you're going to get a high real yield for very little risk when it's issued by one of the top 4 or 5 banks. All right, we've spoken about securitization paper. It's a topic we could probably spend a year on, an hour on, I would say rather, just to go through the different types of securitization paper. And I think it's quite pertinent now. We've spoken about pooling of these types of loans. And then the next thing is what we do is we would tranche or stratify these loans into different levels of risk. So say you had 100 mortgage loans in here, then you would actually create an investment grade piece of paper by saying someone else will take the first 5 defaults, and maybe an investor in the high yield tranche would take the next 5 defaults on their nose, and then the remaining investors would have 10% of buffer before they get into a default zone. This is kind of our securitization paper works at different tranches being issued off of the same pool. And it's obviously very important to know that there's a difference in the credit worthiness of each of these different tranches. You can't just say it's securitization vehicle A. You've got to look at tranche 1, tranche 2, tranche 3. What are the different credit worthiness, credit ratings of each of those different tranches? My personal favorite, if you've got time, I'd like to talk about bank debt, bank subordinated debt. So something that irritates me a lot is when you read on, and that's probably the reason why we've been quite involved in this CISA working group on disclosures for income funds, is that you mentioned earlier that not all debt is equal, right? And in the bank space, not all bank debt is equal either. And this is a stylized graph of what the balance sheet of a bank would look like. And I just want to illustrate 1 or 2 things for you. So if you and I were to start a bank, right, so we would typically go and raise some operating capital. So let's say we need $100 to get our bank off the ground. So typically what we would do is we would put in, if we were a South African banker, we would put in around 14 odd rand of shareholder funds. So you and I would both put in 14 rand, and then we would go out and borrow the rest of that 86 rand that we need to get to 100 rand with. And there are different types of borrowing that you can do. We could go and issue preference shares. So the thing is with preference shares is they've got a similar credit worthiness to ordinary shareholders, but they pay a fixed coupon of whatever that is described to be. Then we could go and issue, and I'll talk a bit more about this now, additional tier 1 capital, right, which is capital for regulatory purposes, but it pays a coupon. So it looks like an additional tier 1 sub-debt of a bank, looks like debt, pays an interest rate, but it gets treated as if it's capital by the regulator. And then you get something that's called tier 2 sub-debt, looks a bit more like debt, a little bit less like capital, but can still be bailed in if there's a problem with a bank. And then we go and raise deposits, right? Those could be NCDs, it could be listed debt, that we call senior debt. Now we've got 100 rand that we've raised, and we'll go and lend it out. These will be our assets on the balance sheet: home loans, corporate loans, vehicle loans. So we'd have to put aside some high quality liquid assets, etc. Now the thing is with how the seniority of credit worthiness works is that if there's a problem on your asset book and you have defaults, the first investor in the capital stack that loses money will be the ordinary shareholders. Yes. After that will be the preference shareholders. So the order of defaults and losses works from the bottom up. So for argument's sake, if your whole home loan book goes to heaven, right, and you've got, this has never happened and probably touch wood won't, but if in our example here, this home loan went to heaven and went to zero, you had a 30% default on your asset book, what would happen is all the ordinary shareholders will lose their money. After that, all the preference shareholders will lose all of their money. Then the AT1, then the tier 2 sub-debt holders will lose money up to the 30 rand, right? But if you look at the senior debt holders, they would actually recover roughly 90% of the debt that they lent to this bank of ours because of the fact that they are senior debt holders. So immediately it becomes apparent that the credit worthiness of the green paper is much better than the credit worthiness of the gray and the orange paper, which is your subordinated debt. And the prefs, and then the ordinary shareholders, right? So immediately we feel a lot more comfortable buying into senior debt of banks rather than tier 2 and AT1. Now the thing is that tier 2 and AT1 debt pays a lot more than your traditional senior deposits for this risk. And I think in South Africa, when you stick to the top 4 or 5 banks, you're actually getting a lot of bang for buck for that extra spread, but that spread has come in tremendously over the past 5 or 6 years because of this growth in the fixed income world. There's so many investors looking to buy the higher yielding debt that we currently just don't feel that the spread, that the extra spread that you're getting out of T2 and AT1 paper actually warrants investment right now. So maybe the spread expands again, and we thought when Credit Suisse had a default event on their AT1 paper, we thought that we would see spreads become a bit more juicy, but we haven't seen that, which is a different discussion. But I think this just clearly illustrates the impact of where you invest in the capital stack of a bank. Now there are a lot of additional nuances here because this AT1 and tier 2 sub-debt, they are very interesting instruments because they've got this thing called bail-in clauses that the banking regulators can actually use the additional Tier 1 capital and Tier 2 sub-debt to bail out not only the senior debt holders, but in some cases, to an extent, bail out ordinary shareholders. And this is what happened with Credit Suisse. So Credit Suisse had additional Tier 1 bonds. I'm just going to get to that slide. Credit Suisse had some additional Tier 1 bonds issued, and they were trading at around about the value that they were issued. This is just an example of 3 of their bonds. Credit Suisse went through a rough patch where they had a run on some of their deposits. The regulators looked at their capital adequacy, and the regulators then decided to bail in the AT1 bonds by writing them down to 0. And all these write-off clauses and these instruments are really complex. But what happened with Credit Suisse is that the banking regulators in Switzerland decided to write down this debt to 0 and to use that money to bail out other holders of senior debt, Tier 2 debt, and even to an extent ordinary shareholders. And these things can happen. So we also see that AT1 bonds, they all lost. This is just a grouping of a whole bunch of globally listed AT1 bonds. They all lost about 20%, then made a bit of a comeback. What we found in South Africa, to my point earlier, is that AT1 bond prices basically did nothing. And the reason, there's another really interesting thing about our market is that the JSE as a way of marking to market credits or less liquid paper, that they would only mark to market the paper when it trades. So we then saw basically the prices of AT1 bonds in South Africa didn't do anything, basically because they didn't trade.
JP, I know that one of your, I think it's maybe your next slide that's coming up now, where you talk about the issuers. You have mentioned now SA governments, SOEs. How important is it for us to know who the issuers are? And does it really carry weight to know exactly who issues what in this environment?
Yeah, I think in terms of creditworthiness, it's super important to know who issued your paper that you're holding, right? So you would want to know, and I think to a large extent, we would all have a good feel for who those issuers are, because a lot of these income funds would hold similar issuer exposures. It's really in these areas of corporates, which would include credit-linked notes issued by banks and securitization paper, that the additional level of diligence is needed to ensure that we understand what those risks are involved in the more opaque part of the market, but the higher yielding part of the market. Then they're all different. So we've spoken about the issuers. This is really going to relate to your probability of default. And then there are all types of different instruments that these issuers can issue. And these will have different functions within your funds. So say government bonds would be the fixed rate bonds. So they would pay a fixed amount of interest for 5 or 10 or 20 years. They could be inflation linked, so your interest that you earn will rise with inflation, and your capital that you get back at the end will also be inflation adjusted. There could be floating rate notes. We spoke about that earlier. There could be treasury bills, would be similar to making a fixed deposit, but a fixed deposit up to 1 year that the government essentially issues. SOEs would mostly be fixed rate bonds with 102 inflation linked bonds. Banks would be issuing different types of NCDs, fixed deposits. They'll have senior bonds, subordinated debt that we just spoke about, and credit-linked notes. And it's important, really more for the asset manager to have a proper mix of bank exposure, and important also to disclose to investors the type of bank exposure that investors are exposed to. So, if you are holding credit-linked notes issued by a big bank, you should also disclose what those credit-linked notes are linked to, because the the probability of default is not only the probability of default of the bank, but also the reference entity that could be a corporate name that you may not feel comfortable having exposure to. And then corporates and securitizations, typically, as I said earlier, they like to issue floating rate notes. They've got very low duration, very low interest rate risk, but they certainly hold a variety of different potential credit risk and liquidity risk that you need to understand as well.
And I think this ties in with your next slide on fixed versus floating. You briefly touched on it earlier as well, but this is a nice example. I think there are 1 or 2 slides that you cover with an actual example of how it works with the fixed rate. Maybe just take us through this practical example.
Yeah, so this is what a fixed rate instrument looks like. This could be a bank issuing a 5-year coupon CD, or a government issuing a 5-year bond, or corporate issuing a 5-year fixed rate instrument. And essentially, let's say in our example, this issuer is issuing their 5-year bond at a rate of 9%. And we have this convention called NACS that says that the 9% interest that you earn will be paid, that coupon will be paid semi-annually. Which means that if you buy an instrument like this, you will receive R4.50 every 6 months. All right, and at the end of 5 years, you will get your last coupon, R4.50, plus your R100 back. So that's how a fixed rate bond or a fixed rate coupon will work in terms of known cash flows that you're going to be getting throughout the term. Then we know that if interest rates move, let's just say tomorrow the same institution issues the same bond, but at a rate of 10%, for R100, that means that the one that we bought at 9% will be worth less, right? Because we can only sell it at 10%. And a bond like this would have a duration of around 4 years, which means if interest rate on this bond goes from 9% to 10%, we'll have a capital loss, which either will be realized or unrealized, of around 4%. So the value of our bond will fall to 94. To 96, or maybe go up to 104 if interest rates come down. So that these type of instruments hold a lot of modified duration risk. They add an element of volatility to your portfolio. This is a floating rate note. Okay, so it's the same term, a 5-year term. We said a floating rate note is just made up of a whole bunch of shorter dated 3-month fixed deposits that you commit to keep on rolling for a term of 5 years. And how these instruments will work is they would be issued at a spread above 3-month JIBAR. 3-month JIBAR is just the 3-month average fixed deposit rate. And let's say on day 1, the fixed deposit rate is 840. That means that you will earn 940. And then you have to divide that by 4 as your first coupon that you will receive. All right, so there would be a first coupon that would be known, but you don't know what the size of your coupons will be in the future. The size of those coupons will depend on what the 3-month fixed deposit rate is in the future. So if the 3-month fixed deposit rate goes up, your coupon sizes will go up. If fixed deposit rates come down, the coupon that you receive will come down. So therefore, you don't have a lot of interest rate risk, but you've got a lot of term risk, right? Because of this credit spread, that 100 basis points can also move up and down, and that could also influence the capital value of your floating rate note in the same way that modified duration gives you a feel for interest rate risk. The term to maturity or spread duration will give you a feel for the exposure to the credit spread that you may have during the term of your investment in a floating rate note. And then we've spoken about credit-linked notes. Floating rate notes that give you possibly even more of a coupon, but typically you would have credit risk linked to some sort of a reference entity that may be a well-regarded reference entity or a lesser credit-worthy entity, and that would influence the spread that you get above the JIBAR. And I think what is important to note when it comes to credit-linked notes is it's not about the bank that issues the note. It's about the reference entity that that credit-linked note refers to. That will give you an idea of the credit risk that you have on those holdings. Right, so I think that's about it.
Yeah, I think this has been actually so insightful in the sense that firstly it feels like a bit of a CFA class again, so thank you for just really going through
Sorry
some
about
of this. No, that's a really a good thing. So going through some of the lingo and the jargon and the terminology. I mean, when we sit in front of managers like yourself, you guys use it very easily when you converse and you use these terms, and then often it feels like, you know, you miss some of it. So you miss it, like the finer nuances within an income fund or what it might mean or not mean. And I think what I have taken away from it thus far is that there are obviously some risks involved, such as, like you mentioned, the issuers, what's the reference that linked to, like your credit linked notes. So there are some smaller things that you also need to consider, even adding a fixed rate note. I just heard you now saying how the volatility can be added to a portfolio, for instance, and the fact that you can actually diversify away some of your risks by adding more, and not like with equity markets where you actually get to that point of no diversification, adding, you know, more to it. So that for me is already very beneficial. And I'm glad that you have this slide on, because I think this is important for our advisors that, you know, if you make use of our diversified income fund, which Matrix and manages, I mean, you briefly touched on this, where the stuff that you will not use or consider within your team. But I want to focus on this slide and then have you maybe end of this session today by asking you a question as well, to say that, do you think there are certain credit events that might still unfold, things that we might need to consider in the future going forward in the next couple of years? Firstly, given perhaps where interest rates are at, I think that's quite crucial. So what can we expect from the economic environment for income funds going forward? And then maybe just in closing, you can share with us your positioning that you currently have.
Sure. So you know, because we focus on the liquid end of the market, we feel very comfortable with our current exposure, which is limited to AAA SA government and AA senior bank debt at the moment. But that doesn't mean that we don't value credit investment generally. We're just saying that that's not really our game. And I think that there are managers out there that are very good at picking diversified credit portfolios outside of this area of focus. And I think it's important to note that could add value. That extra yield that you get does add value. You just need to understand the spread risk that you've got there, the credit risk that you have, and potential liquidity risk that you have in investments like that. So in terms of how we see things unfolding, we've spoken about the paradigm shift in South African interest rates. We are already a high yield country. You know, we get referred to as our government bonds overseas, or referred to as junk bonds. So is it then necessary to push the credit envelope even further? And I think there is where the specialist credit managers need to spend a lot of time. And you know, we're already getting out of government and bank paper, senior bank paper, we're getting inflation +4, inflation +5, inflation +6%. If you're in the game of inflation +8 or 9% in the debt market, I think you are then starting to take on a considerable amount of default risk, which may or may not warrant a position size in an income fund. So that's our feel at the moment. I think in a nutshell, we're all being spoiled with very high real yields issued by SA government, senior bank, potentially a few large blue chip corporates, and maybe some of the subordinated debt from one or two of the big banks. We personally don't feel it's necessary to venture out much further than that, because we can already get inflation +3% out of the AA rated book.
Thank you so much, JP. I really appreciate your presentation this morning, and I think it's been so valuable for our audience as well to take in a bit of this credit space and credit markets and what to look at. And I would like to urge all our viewers that's on the call this morning, also have a look at the Amity VCI Diversified Income Fund. It has done exceptionally well, given that since they have been managing this mandate, we have really seen some great performance. So thank you to everyone who attended this morning. Again, I'd like to say thank you to Matrix and to JP, and we will share this webinar as always on our YouTube channel. Keep an eye out on our LinkedIn communication. Thank you so much. Have a great day. Goodbye.
Thank you, Tanya. Appreciate it.